Greetings from MWN.com. Dr.M.Wilson, formerly Vice Principal and Head of Department of Commerce, Scott Christian College, Nagercoil is delighted in presenting this session. Thank you. Please subscribe the channel MWN.com. Multiplier effect. The multiplier effect is an economic principle that describes how a change in one economic factor can lead to a larger change in another factor. The factors may be called as variables. In economics, a multiplier broadly refers to an economic factor that, when changed, causes changes in many other related economic variables. Multiplier effect can be used in reference to the relationship between government spending and total national income. In terms of gross domestic product, the multiplier effect causes changes in total output to be greater than the change in spending that caused it. Economic factors. Examples of economic factors include economic growth, unemployment rate, inflation, interest rates, exchange rates, and commodity prices. An economic factor is a variable that affects the economy, with respect to the economic development of a country and the financial state of a business. Hence, it has three components and they are stated as follows. 1. Economic development. Economic factors influence a country's ability to develop and increase its standard of living. This can be measured in terms of GDP, employment, poverty level, etc. 2. Business finances. Economic factors affect a business's labor and production costs, investment value, and purchasing power. This is concerned with cost of land, labor, capital, and entrepreneurship. Business finances can be known from the amount available to them in the banking and financial institutions and the amount utilized through borrowings from these sectors. 3. Household finances. Economic factors affect a household's income and purchasing power. It depends on price level, employment, wages, and salary. The impact of it can be known from income, spendings, and savings. Savings can be well measured through the various types of deposits of households in banks, other financial institutions like non-banking financial institutions, post offices, etc. Economic factors can come from a variety of sources, like political, social, technological, legal, and environmental. Some economic factors can have a greater effect on the economy than others. For example, a change in interest rates is likely to have a greater effect than a change in gasoline prices. One more example is related to direct tax, income tax, and indirect tax (GST). Goods and services tax. The reduction of tax by government will create more money in the hand of households and which will create more demand of goods. It also increases savings and simultaneously increase deposits in banks, which will be beneficial to industry for increasing production and supply of goods and services. Examples of the multiplier effect. 1. Government spending. The spending of government increases, it impacted a chain reaction of additional spending throughout the economy. 2. Donations. The donations of money to a non-profit organization by local people impact the spending of money for social causes. This will create income for others. 3. Bank deposits. The deposits of people of a large amount of money into their bank account impact the banks to lend more money to business and personal loan. It stimulates spending of people and production of more goods and services. Marginal propensity to consume (MPC). The multiplier effect is associated with the marginal propensity to consume (MPC) and the marginal propensity to save. The MPC is the proportion of income that people spend, and a high MPC means that the multiplier effect will be greater. The multiplier is the amount of new income that is generated from an addition of extra income. The marginal propensity to consume is the proportion of money that will be spent when a person receives a certain amount of money. The formula to calculate the multiplier is M equals 1 divided by 1 minus MPC.